Hey Mike, how you doing? It's Will Caban from Fairway Mortgage. So I wanted to take about 15 minutes to just go over some questions. What property types are you looking at? You have single family homes, you have townhomes, you have condos. Condos. Okay. And how much you want to put down? 5%. Okay. All right. Can you hold on one second? Guys, so let's talk today about why condos get such a bad rep. Some of you already know I work in the South Florida market, densely concentrated in the condo space for miles and miles and miles and miles and miles. Let's talk about why condos get a negative rep. When it comes to doing financing on a condo, you have choices in terms of loan options, but really do you? Because when you try to go FHA with a condo, it's not an easy process, and this is where some of the pitfalls lie when trying to do financing for condos. You're usually pigeonholed into going conventional loan only. Now, that's not a problem, but it does create some limitations if you're on the lower tier of the credit score, because what happens is you get higher pricing for having a lower credit score, but you also get higher pricing for having a condo when you're putting down less than 25%. And that's one of the biggest drawbacks and negatives when it comes to condos, is that you're limited to the type of program that you can go with. FHA is available, and I'm not going to say that you can't do it, but trying to do it has created very, very difficult obstacles. The second reason why they get negative reps is because you really don't know what you're getting into until you're actually into it. What I mean by that is condos have to go through a review process, just like you and I do on the underwriting phases. We have to get a condo questionnaire completed. We have to make sure that they have adequate reserves in most cases. And if you're putting down more than 20 or 25% in Florida, then you don't have to necessarily concern yourself with reserves, but you do need to still be aware of other things that go on in the review process, such as master insurance reviews, co-insurance reviews, litigation reviews, 40-year certifications, and the list goes on and on. The major part of what a condo team will review for an approval is something called a condo questionnaire, and it's usually about a 4 to 8 page document that not until recently was pretty much standardized, but a lot of institutions would just send out their own condo questionnaire that may have had questions, additional questions that Fannie Mae and Freddie Mac didn't necessarily need. Now it's more or less standardized, but there's still some complications because we can't get those items completed in most cases without the borrower, that's you, paying a fee to get that. So in most cases, when you get into contract, you have a few upfront fees that you got to be aware of. You have your inspection, you have your appraisal, and you have your condo questionnaire. So you could very well be into a transaction for $1,000 and not know until a few weeks before closing if the condo is even going to get approved. Let's go into the reviews because I think that's important. So for starters, you have two types of reviews. You have your full review and you have your limited review. Now, what does that mean? Well, a full review is a review when you're putting down less than 20% in every other state except Florida. Florida, we still have a rule that existed when the housing crisis was at its peak and Florida got hit the hardest, where if you're putting down less than 25%, then you have to go through a full review process. The limited approved process is basically you putting down 20 or 25%, and we're not looking at some of the items that you would normally look at, like a reserve study or a reserve calculation and things like that. You still have some of the items that I mentioned earlier that you have to be aware of when it comes to that. When you're doing a full review, it's highly scrutinized because you have to make sure that that reserve is not only being collected, but there's a certain calculation and there's a certain percentage that needs to be collected by a condo association. Now let's get into the reserve really quickly because the reserve is really important to understand. So I want to preface this with the fact that if a condo doesn't necessarily collect reserves or enough reserves, it doesn't mean that it's a poorly run condo. On the contrary, it can mean that it's very well run and they just don't have any reason to spend any capital over a certain period of time. So if you understand Fannie Mae's reserve collection requirement, they require 10% to be collected relative to what the maintenance is being collected on an annual basis. So as an example, if you're collecting $1 million a year in assessments for an entire building or an entire association, that means that you have to collect $100,000 every single year just in a reserve allocated account. Now, if you do that for 5, 6, 7 years, you're going to have a pretty hefty and pretty substantial account balance in there. Now, of course, you have protections like insurance and things like that, but as you grow that account, your risk starts to expand. And what happens is you create an account that you have a lot of money in where somebody can unfortunately go into and have access to, and usually in most cases only a couple of people have access to these accounts, or what ends up happening is it becomes expensive because you have to have insurance to cover those balances every single year. So from a reserve standpoint, it's really important to understand the perspective of an HOA. If I have a bunch of money in an account that is earmarked for an emergency or earmarked for upgrades and updates and renovations and certifications and things like that, but we don't have a reason to allocate any more funds because we've spent everything and we've renovated and we've updated everything, I'm probably not going to collect 10%. I may shut it down to 5%, or I may just altogether say, you know what, we have enough in our account, we're just going to carry it over until we actually need something in the future. And again, just because an association doesn't collect enough reserves doesn't mean that it's a poorly run association. On the contrary, it could be a very well-run association. Another pitfall in regards to condos is litigation. Now, litigation is a litigation that's brought on the association or the association bringing litigation against someone else, something like a third party, usually a developer or someone along those lines. There's two categories and classifications of litigation. You have minor litigation and you have major litigation. Minor litigation would be something along the lines of like a slip and fall that usually can be handled in civil court, and if not, it can be handled and covered by the insurance policy that the association covers. Major litigation is something along the lines of structural defects, something that's going to impact your ability to live in that condo or that association safely. If anything exists that would restrict you from being able to live in a property that has, say, structural defects, cracks in the foundations, you have roof issues, roof leaks, things like that, there's going to be enhanced due diligence on the litigation portion. We're going to want a lot of documents that are associated with that, and in most cases we're going to want attorney opinion letters, and those are not necessarily easy to come by. So litigation could definitely be a deal killer. Fortunately enough, when we get into things to look out for and how to spot it, we'll talk about how you can prevent or at least mitigate some of these surprises later on. Another thing that we want to talk about is a 40-year certification. 40-year certification really wasn't something that was highlighted too much in the past, but with recent events, they've kind of been at the forefront, especially in the South Florida, Miami, Broward market, because of the fact that the 40-year certification is really a certification for the safety and habitability and just the overall soundness of a condo. Ultimately, if we are getting close to a 40-year certification or a building is going through a 40-year certification, there's certain things that you're going to want to look out for when it comes to where they are in that process, right? We've had associations that unfortunately are well past their 40-year certification and they just don't have that being done in the near future. And that puts them in a position where in most cases they're not going to be able to be financed, unfortunately. And it's a detriment to the association, because when you're an owner in the association and you're looking to sell your property, if you can't market your property to an audience that could do a lower down payment, you're going to restrict yourself, or you're going to have to end up going with a lower purchase price when you put it on the market, because you have to attend to an audience that would be able to qualify or afford it at a lower down payment. So definitely something that you want to be aware of. And then the next item is master insurance. Master insurance, co-insurance, flood insurance, just insurance in general is a hotbed topic, especially in South Florida, because if you have a property and it's in a flood zone, the association has to have flood coverage. If it doesn't have adequate coverage, in most cases, the potential buyer can go in and purchase something called a gap flood insurance policy that would make up whatever the difference of the shortfall is. But if they don't have any flood insurance coverage and it's required to have flood insurance, they're not going to be able to be financed because they're inadequately insured. And then on the flip side of that, you have co-insurance, and usually the reason why co-insurance is opted for homeowners associations is because it's a less expensive way to insure certain parts of a condo project. So you might have co-insurance covering a pool, you have another co-insurance covering a gym, you might have another co-insurance covering the main area, the main lobby, and it's not uncommon on a master insurance policy to see 5, 6, or 7 different companies. And the issue with that, it comes down to replacement cost value. And I'm not gonna get too crazy into this video with that. I'll probably do another video on co-insurance. But to make a long story short, if co-insurance is not at 100% replacement cost value, in most cases, there's gonna be issues when it comes to that. There's other ways to get exceptions and go around it by speaking to Fannie Mae directly and seeing if they would make exceptions. But for the most part, co-insurance, the moment you see it on a master insurance policy, you want to bring it up to the attention of your loan officer and just make sure that you kind of streamline it. One of the, and I should have put this as the first one, but I think one of the biggest pitfalls when it comes to condos is your reliance on so many third parties. And this is where a transaction that could normally take 21 days to close can take, upwards of 45 days. And that's chasing down a management company, chasing down the insurance company, chasing down the HOA for all of these different items and not being in control of any of those third parties. So if you're in a transaction, the best thing to do is to chase those things as soon as you order the appraisal. And that's what we do when we order appraisals and we disclose our loans, is we're ordering the condo questionnaire, the master insurance policy, and any other items that are pertaining to the condo pretty much all up front. And that's one of the biggest pitfalls. If you have to start chasing people, or people are not responsive, or they're not picking the phones up and they're not responding to emails, it creates a really difficult position for you to be in as a loan officer and as a client, because you're trying to perform and the other parties that you're relying on unfortunately are not performing. So that's a really big pitfall, and probably should have been the first one. Now let's talk about things that you could do to mitigate or potentially prevent any surprises or any issues when you're going into a condo. The first is most owners will have a copy of the most recent budget. So any year that we're going into, we want or we need an approved budget for that year. So it's year 2021 right now. So when I see a budget, I'm expecting that I'm getting a approved 2021 budget. And the reason why we need that is because things change from year to year. So if I have a 2020 approved budget and I'm looking at this and it looks good, and I'm heading into 2021 knowing that the HOA might change certain things, a condo might be approved in 2020 and it may not be approved in 2021. So as I record this right now, it's September 2021. In a couple months, we're gonna need to have 2022's approved budgets. So be very mindful of this. The thing that you need to be aware of is, are they collecting reserves at all? If they're not collecting any reserves at all, you're not going to be able to put down the 5% that you wanted to put down. In some cases, and this is a big asterisk, in some cases you can put down as little as 10%, and you can finance it with a first and a second mortgage. That's a little bit more complex, but I wanted to get that out there so you guys understood. The first thing that you could do, and you don't need to be in contract, you don't need to necessarily go beyond the fact of a conversation. Any good listing agent's gonna have access to that. A seller gets access to a budget every single year. You send it to your loan officer. The loan officer should be able to read it. If they can't, they send it to their condo team. The way that some associations do them are really confusing. So having a second set of eyes on there does help. By doing that and taking the extra steps and the extra couple of days, you mitigate any expenses that you have, even simple expenses like wiring money to an escrow agent. Second thing that I would do is I would ask if there's any litigation in the building. Simple question to ask, but in most cases, listing agents may not know that. So you might have to go to the association and you may have to request any additional information with regards to litigation. And if there is litigation, then what you're going to want to do is you're going to want to find out what that litigation pertains to. You want to see if there's any potential for it to not work out favorably for you. Lastly, one of the big things you need to realize when it comes to condos is it's not uncommon to get all the way to the end of the transaction or very close to the end of the transaction only to have a surprise pop up. You have to prepare yourself for a situation where if a condo can't get fully approved, you're either going to pivot and put down slightly more and maybe entertain doing a first and a second mortgage, or just doing a first mortgage with a higher down payment, or be in a position where you understand that you may have put resources and energy and money and time into this and it may not work out. Unfortunately, that is something I do coach and prep my clients on, because of the fact that there's a lot of moving parts, and if one party is being really responsive but the other two parties are not being very responsive, and we don't get answers till later in a transaction, well, unfortunately, that's something that we couldn't control, you couldn't control as a client, the real estate agents couldn't control, and we just have to work with the means that we have. So it's very important to be extremely aggressive in the beginning with the associations, with the insurance companies, with the management companies, so that you can work on getting the associated documents that you need, so that you're in a position to know earlier than later if this is a condo that you can actually move forward with. I hope you guys found this information helpful. I'm planning on doing some videos related to the master insurance, the co-insurance, the reserve, how to read a budget, etc. But if there's anything that you have questions on, anything you have comments on, please feel free to leave some comments down here. And if you ever have any questions, you can always feel free to reach out to me. Thanks and take care.